every single real estate deal you've ever lost came down to one thing. Not the market, not the property, not even the numbers, but the terms you accepted because you didn't know how to ask for better ones. And right now, with rates where they are and private capital flowing like never before, the investors who know how to negotiate with private lenders are absolutely eating everyone else's lunch. Let's back up and understand what a private lender actually is. Because most people picture some shadowy figure in a back room, when really it's your dentist, your aunt's friend from church, or a retired engineer sitting on $400,000 in a self-directed IRA with nowhere interesting to put it. These people are not banks, they're human beings with emotions, fears, and a desperate desire to feel smart about where their money goes. The market shifted somewhere around 2022 and 2023, when institutional credit tightened and suddenly everyone rediscovered private money like it was some ancient buried treasure. Except the treasure was always there and people just forgot to look. Deals that used to get rubber stamped by regional banks started dying on the vine. And investors who had private lender relationships were suddenly the most popular people in every real estate Facebook group on the internet. Here's the psychological truth nobody talks about at the RIA meetup. Private lenders are not evaluating your deal nearly as much as they are evaluating you. They're asking themselves whether you're the kind of person who calls them back, tells the truth when things go sideways, and treats their capital like it's borrowed from someone they genuinely respect, because it is. Think of it like this. A private lender is basically hiring you to be the active manager of their money. And just like any job interview, showing up with receipts matters more than showing up with swagger. Your track record, your transparency, and your systems are the resume. The deal is just the job description. Now, here's where most investors blow it. They walk in cold, pitching a deal before they've ever built a single minute of relationship capital, like asking someone to marry you on the first date while also asking them to pay for dinner. The investors who consistently get the best terms, lower rates, interest-only periods, flexible extension clauses, are the ones who built the relationship 3 deals before they needed it. History backs this up in a pretty humbling way. Because if you go back through every major private lending boom, the hard money explosion of the 90s, the note market frenzy of 2005 through 2008, the private equity surge, post-pandemic lenders always gave better terms to the people they trusted, not the people with the flashiest pitch deck. The pattern repeats itself like a greatest hits album nobody asked for, but everyone ends up knowing by heart. Here's the misconception you need to kill right now. Negotiating better terms does not mean you're trying to take advantage of your lender. And any lender worth working with understands that a deal structured for mutual success is a deal that actually closes and performs. Asking for interest-only payments on a 12-month bridge loan isn't greed. It's math. It's protecting your cash flow so you can actually execute the business plan you promised them. So practically speaking, walk into every lender conversation with 3 things: a 1-page deal summary with clear numbers, a simple explanation of your exit strategy with a backup exit, and at least one story from a previous deal where something went wrong and you handled it with integrity. That last one is worth more than a perfect pro forma, because perfect pro formas are fiction and lenders who've been around know it. When you're actually at the negotiating table, even if that table is a coffee shop booth anchor, high on your ask and low on their risk, meaning you lead with the strongest version of what you want while simultaneously de-risking every concern before they even voice it. Offering a personal guarantee, a first lien position, or even an equity kicker on a particularly juicy deal can shift the entire conversation from transactional to collaborative. The irony of private lending is almost too good. The investors who need the best terms the most are often the ones least positioned to ask for them, while the investors who've already proven themselves could probably get money at nearly any rate because they don't desperately need it anymore. Conviction without a track record is just confidence, and confidence without receipts is just noise. What this really comes down to philosophically is that you're not negotiating alone, you're building a financial partnership that, if done right, will fund the next 10 deals and the 10 after that. Discipline in how you structure, consistency in how you communicate, and humility in how you report back to your lender are the actual compound interest in this game. Everything else is just arithmetic. Sizing matters more than any single term you negotiate, because agreeing to a slightly higher rate on a well-sized, well-executed deal will always outperform squeezing a lender on terms and then over-leveraging into a deal that eats you alive. The best investors we've ever seen aren't the ones with the most audacious ass, they're the ones who knew exactly how much risk they could absorb and structured accordingly. At the end of the day, you can be completely at peace with whatever terms you land on, as long as you walked in prepared, communicated with transparency, and built a relationship worth coming back to, because the goal was never one deal, it was a career. Whether the lender says yes, no, or counter offers you into something you didn't expect, rational preparation always beats emotional desperation in this business. If you want help navigating all of this, whether it's real estate investing strategy, finding the right private lenders, connecting with contractors, or getting linked up with financing options that actually make sense for your situation, check out the links in the description below, and let's build something together.